It's 2020. We're happy to be here today and welcome everybody into the new year of 2020. I'm Paul Rudy, host of Paul Rudy's On the Money radio show. I'm with a couple of my regulars. I'm going to have Fred here in a minute on the phone if I don't mess that up. So we will have Dr. Fred Gertz via the phone. We have Certified Financial Planner Professional and Retirement Income Certified Professional David Rudy and Certified Financial Planner Professional Ryan Repko. Good morning, guys. Happy New Year to you. I think it's Happy New Year. That was a great year last year.
Our first show of the year.
And last year was a great year. We're going to talk a little bit about it. You can call in, of course, with your questions at 217-356-9397 and text us on the Castle Heating and Cooling text line at 351-5357. You can also email your questions to talk@wdws.com. It's important to recognize that past performance is not an indication of future results. You should not make any investment decisions without first consulting your own financial advisor and conducting your own research and due diligence. I'm using my glasses I normally don't use. I usually use my readers. These are my transition glasses or whatever they are. So sometimes it gets a little blurry when I'm reading this stuff. So I really can read. I promise.
And just a reminder, today we're going to attempt Facebook Live for anybody who likes to see us in person. If you don't already steer away from our voice, you get to see us in person on Facebook.
And they can see my groovy new glasses. They make me look so young, I'm told. Well, okay, that's what I say. Maybe they don't. Dr. Fred, are you there?
I'm here.
Oh, great.
Good to talk to you.
Yeah, so you're traveling once again, Fred. You travel more than anybody I know.
Well, this isn't a long trip. It's Chicago, so.
I'm starting to think you're in the witness protection program, Fred.
Right.
No,
Well, he was, not anymore.
That's right. Well, it seems like as long as the good old American consumer, Fred, keeps spending like they did in 2000, and it looks like it may be up to the consumer, maybe we'll have a decent 2020 from an economic standpoint.
Like it. Again, you never know, as we say every time, but everything looks good for a continuation of this slow growth, and the slow growth has been a long time coming, but we're 10 years into the recovery. Stock market especially is doing well, and it's survived all kinds of things, including the Iranian activity, which is like a one-day downturn and bounced back almost immediately. So again, it has a very long term of slow growth, and it looks like it's going to continue. Again, I don't think anybody expects another year like 2019, although it's always possible. But again, modest positive growth is certainly a likelihood.
And from that standpoint, I was looking at the data, and I don't know that there's anything even to make of it. But it looks like if I look at economic growth between the mid-2009 period to 2017, we had real GDP at about 2.2%. Since 2017, it's been a little bit higher, 2.6%. That doesn't sound like a lot, but it's 20% more output for the country over the last few years. Is there even anything to make of that? Is that because of the tax cuts for business and maybe business investment?
I think
are they even related?
The part of it, but again, that's very likely short term. Also, the reduced kind of the regulatory issues may be of some help as well. But I think more importantly, it's just the fundamental soundness of the U.S. economy. And
that really, when we really think back to consumers, we think, well, if everybody feels pretty secure about their jobs, wage growth until recently has been around 3.5% a year. Now it's a little bit below, but I'm just wondering if that isn't almost a Goldilocks scenario, where maybe the jobs report Friday wasn't as good as everybody had hoped. It was a little below what expectations were, but it makes me wonder, well, maybe that keeps the Fed on hold from increasing interest rates. The consumers.
And also,
go ahead.
Adding jobs is not an easy thing to do once you're close to full employment. So when you have less than 4% employment, there's not a lot of people around who are able and willing to work. So it makes the job creation all the more challenging, which actually is a good situation to have.
And it doesn't appear, though, that it's spiking wage growth. It's been handsome, but not in a way, to me, that it appeared to degrade the profitability of corporate America. So to me, it seems like if we can be in 2.5% to 3% growth, and I know there's people that are suggesting that we won't be that high this year. I won't be surprised if we are. And if we are in that neighborhood, that's still pretty reasonable growth. And it is kind of I always think back to past periods over my 3.5 decades that there are certain periods I call Goldilocks periods. They're not too hot. They're not too cold. We don't have capacity utilization that's too hot. We don't have a trend towards higher taxation. Clearly, regulatory burden has been reduced. Maybe 2020 we still get through that without a recession.
Right, and Goldilocks doesn't mean necessarily you're the top of the range in terms of growth. For example, the period from 2000 to 2010 was really a time of explosive growth, but obviously ended badly. So again, in the 90s, the 1990s were the same way. So this doesn't seem to have the same pattern of the kind of explosive growth before the fall that we had the last two downturns.
Well, it certainly seemed like everything everybody worried about last year didn't have any impact on the stock market. We had really strong gains in the broad U.S. market, close to 30%. Globally, probably in the 22 to 24%, depending on how you had your mixture globally. I think that caught a lot of people by surprise. It was only a year ago, or a little more than a year ago. A lot of people had thrown in the towel. They were so frustrated at the tariff war and the tweets and all that. There was the sentiment where it really was quite negative. And I think a lot of people chose to give up and say, well, we have a recession. Then, of course, there was the worry about the inverted yield curve, which I argued really what shouldn't have been a concern because real interest rates were not high. It always seems like the risk is all the things we don't know about. It's never the things that are obvious to everybody. That's what it seems like to me.
Yeah. Well, we talk about risk in kind of one-sided way. Actually, risk in a technical way is both risk on the upside, risk on the downside. So it's not always that risk means things will get worse. Sometimes there'll be something happen unexpectedly that makes things better rather than worse. So again, we may have been on the right side of risk this particular time.
Right. And those strong gains, of course, obviously, the people that hung around and had the patience and the faith and the discipline to stay in their holdings of the stock portion of their portfolio, probably, saw all-time new highs in their portfolios. And what a wonderful thing.
Yeah, and always the reminder, this might be a time to think about rebalancing if we haven't done that for quite a while. So.
Yeah, you take a year where the broad U.S. stock market's up 30% or so with dividends reinvested, of course. Almost any allocation. I know we did. Would it be safe to say, Dave and Ryan, that we did quite a bit of rebalancing in the second half of last year?
Yeah, I think so. I usually use cash flows. So most of our clients are retired. So when we're freeing up cash for their, monthly, call it a paycheck, I guess, we're selling the things that are overweight. So they tend to kind of stay in balance.
Right.
But for the people who didn't do that, yeah, we've had to do some rebalancing, particularly trimming some of the U.S. stock allocation, just because the U.S. has for years now done better than international.
And that's kind of countercultural. My experience with investors are, if they're thinking of rebalancing, they want to rebalance to the things that have made them happy over the last block of time, as opposed to trimming them down. But I guess that's our job, isn't it?
Yeah, for sure. And not even just U.S. versus international, but you see it with, large companies versus small companies or value versus growth. Lately, the things that have been doing well are the largest, growthiest companies, particularly kind of tech stocks. And those are the things, if people have been listening to our show for a while, we actually pretty much underweight those areas of the market and overweight smaller companies and value companies, and those haven't been doing as well. And it's a similar deal where I think the natural reaction is, man, this value strategy doesn't seem to be working. Maybe we should, shift more of our money into growth strategies. But if you're really being a disciplined investor and you have specific targets for everything, you should be trimming back that growth position periodically just to get back to where you were.
And especially, and we're going to talk about the last decade, but if you look at the last decade in the different asset classes, large growth companies in the U.S. Have done something that's kind of unusual. They provided a return that was almost 70% above its normal trend line compounded rate of return. And if you look at things like the CAPE ratio, which is the cyclically adjusted price earnings ratio by Bob Shiller, the Nobel Prize winner, we don't use it particularly we really don't use it other than as an observation, but it certainly suggests that maybe U.S. large company stocks, maybe their valuations aren't so favorable, particularly in relative to the international stock market, where they're trading at a CAPE ratio that are about half of what U.S. stocks. So I've been through a period like that. People, we soon forget, but though this, they always say history never repeats, but it rhymes. It certainly rhymed a lot, not to the same magnitude, but the second half of the 1990s, when the largest growth companies just outperformed everything by a wide margin. And it trapped a lot of people into thinking maybe diversification doesn't make sense, and maybe this is time to load up on 3 or 4 of the largest growth companies, only to see that strategy crash against the rocks of reality. And I maintained, it's public. I was on the radio. Somebody could call me out if this isn't true, but I suggested all along through that period, as difficult as it was, that investors remain invested and not just align themselves in the largest U.S. companies. And of course, going into the next 20 years, large U.S. companies, if we look back now, have had one of the lowest returns they've ever had in over a 20-year period in history, right at about 6% a year compounded. That's well below the historical average for U.S. large company stocks. And that's, again, goes back to the end of 1999, when the CAPE ratio was very high. We're going to talk about why that is not necessarily true a little bit later in the show.
Yeah, and I think the tricky part is, even if you're just rebalancing, U.S. large growth stocks could continue being the best performer for the next few years, and you're going to feel wrong for a number of years until you don't. And the key is just rebalancing is not a market timing tool. It's not a way to, buy low and sell high or vice versa. It's just, look, we have these targets for a reason. We decided that this portfolio was aligned with our financial goals and our investment goals, and we're going to stick to it. And part of sticking to that is making sure that as things drift, because investment returns differ between asset classes, we just get back to where we started periodically.
And that's just common sense, active risk management. It's just saying, look, we want our portfolio to have a certain flavor, and it's aligned with our goals. When it becomes out of alignment with our goals, we have to pull it back and say, no, we established these targets for very specific reasons.
Exactly. And that's what I always remind people. It's like, look, you chose this allocation for a reason, hopefully for a good reason and based on a financial plan. And hopefully with, the sub asset classes, growth versus value, US versus international, it's just because you want to be properly diversified, own everything in reasonable proportions. You want to stick to that. There's no real reason to change unless you had a crystal ball, which you don't.
Yep. And I think one thing that I think about too is, what's the alternative? The alternative of not rebalancing is, in my opinion, more or less placing a bet, because if you've gotten loaded up on large growth stocks like so many investors have because of how the returns have been the past several years, your portfolio is out of balance in those positions. And if your thought is they're doing well, I'm going to let them keep going, by a percentage basis in your portfolio, those are getting larger and larger percentages, and you're placing more eggs in that basket, which eventually there'll be a reversion to the mean. It's going to, at some point, maybe tomorrow, maybe not for several more years, it will revert back. And there's no reason to do that when you can rebalance and keep yourself aligned to essentially a plan, or what you've put in place is what's reasonable for your allocation.
And then it's managing expectations at the same time. We expect a certain allocation to behave a certain way. And, one of the most dangerous things to do is to not, to be caught off guard, caught by surprise that your portfolio could do such, go down as much as you didn't think it could. It's because you didn't actively manage that risk and rebalance when you needed to. So that's a good point, Fred. I'm glad you brought it up.
Yeah, it might be also important to tell people that you're talking about a little bit more complex rebalancing than we usually talk about. Usually we talk about just shifting from stocks to bonds, but you're talking about an internal shift among the different equity categories, which people might not be able to do very easily if they have the one index representing both U.S. and international stocks.
And the nice thing is, when you use those really broad funds, most of those funds are kind of rebalancing under the hood anyways. They kind of have their targets or mandates for how they're going to be managed. So for most people, you almost don't need to worry about those specific like sub asset classes. And by far the most important is just stocks versus bonds. So, if you're not someone who likes to get into the nitty gritty details, at least just make sure your stock versus bond ratio is good. And then beyond that, just be reasonably diversified, and you don't have to worry about, if something's 1 or 2% higher or lower than, you started out. You just want to avoid the extremes, the big drift from kind of where you started.
And I think that's the big key. I think, get that stock bond mix right first. If you stopped right there, I don't think you're going to get a lot of argument from us that you didn't do your job. So I think that's key. Fred, anything else we need to think about going into 2020? Is there anything keeping you up in 2020 from an economic perspective that people might not be thinking about?
You'll probably talk about this either today or in the future, but my estate plan changed considerably when the new secure law was passed, because my goal was to transfer to my children and grandchildren the qualified accounts and have them spread out over their lifetime. That's no longer possible. So I think you'll probably talk about that in detail at some point, but people should be aware of that the rules have changed considerably in terms of if you're trying to pass along assets that are in a 403B, 401k, and so on. It's not the same set of rules that we had prior to January 1st.
That's certainly a big change going into 2020. What Fred's talking about is the Secure Act, that passed recently, effective January 1st. And one of the big deals is, in the past, if I had this large tax deferred account, like a 401k, as Fred said, or a 403b, and I'm going to end up leaving that to somebody I dearly love. In the past, if the person was much younger than you, for example, they could take out those required minimum distributions maybe over a 30 or a 40 or a 50-year time period instead of a 10 or a 15-year period. In other words, what they have to do now is before 10 years come after death, anybody who inherits that type of an account is going to have to deplete it by the end of that 10th year. And suddenly that's a big switcheroo for a lot of people. We're going to talk about that a little bit later today. But suffice it to say, I think that the one implication it certainly triggers in my mind, guys, going into that, the fact that now that ability to stretch out that those distributions over a younger person's lifetime, is that there's probably going to be a lot more thought given to Roth conversions and converting money to Roth. And I find that almost every calculator out there that I can find is overly simplistic. And so how I like to simulate, and how I like to create one column 1040 tax returns. I'm marrying the two together, and I hope within 2 to 4 weeks to have the mother of all useful Roth conversion calculators that actually deals with all the things, that when you say, should I convert money to do a Roth, it's like every other financial situation except on steroids. It depends, and it depends on a lot of things that we're not going to know ahead of time. Mm-hmm. We're not going to know what your tax bracket is in the future, or your kids' tax brackets are in the future for sure. We don't know how big that tax deferred account might be. That depends on returns. We don't know what returns are going to be. It depends on how long we might live. It depends on a lot of things that we have to model realistically and sensibly. And the only way you're going to get a real accurate representation of a distribution of outcomes, what percentage of the time do I think I'm going to be happy having converted this Roth, is by marrying good simulation with a year-by-year tax return. And if anybody thinks that's easy, if somebody has one that does it extremely well, I'll buy it. I won't create it. I don't think it exists. And so that's how seriously, Fred, we're taking it. We're going to really step up our game on Roth conversions. I've already created some versions of it, but now the fundamental change is it's not just what are the marginal tax rates of the children over their lifetime. It's over the next 10 years. That's the fundamental change in the calculator.
One possibility, too, that you might think about, there could be a kind of de facto stretching it out. So if a child inherits, or a younger person inherits an IRA and has to, or whatever, and has to take it out in 10 years, probably what they should do is max out on their own contributions to their own 401k or 403b, and then live off the money coming out of their inherited one. So it's a way of kind of replacing the inherited one will last your whole life.
And hopefully keeping their taxable income down a little bit to help offset the extra income that they're getting from the distributions, the required minimum distributions.
Right. Depending on how much they could actually contribute on their own.
Right.
They could, in a sense, take it out of one account and then put it back in another account and achieve the same goal, except they wouldn't have to take it out over the 10-year window.
Yeah, I think we're going to find it's a lot easier for people. It's not unusual for people that come to us that, they're 60 or 62 and they're retiring, and typically they'll tell the higher earner, the higher Social Security check person to delay till 70. And if they have, depends on the structure of their overall investment accounts, but if they have some money, I don't want to say significant, but a reasonable sum of money in non-tax privileged accounts, just personal brokerage accounts, a lot of times we can manage their marginal tax rate the first 3 to 7 years in retirement and keep it really low right now. That's only going to make this more important, and some of these strategies more important.
Well, because
one final
okay, go ahead, Fred.
Final point about the Roth. The advice I didn't really have options in the Roth early on because it exists, but the investment people always told me was, well, you'll have a lower tax rate when you retire than when you're working, so it's always good to defer. That turned out not to be the case. So you can't depend upon a low tax rate when you retire. Yeah,
that's for sure. But I will say, for the majority of our clients, however, most of them are surprised to find out how low of a tax bracket they'll be in. Now, we're very favorable tax treatment in Illinois because they're not taxed on a lot of their income in Illinois. And if you really look at on a federal side, a couple can have a little bit over $100,000 in taxable income, then net of a standard deduction still remain in the 12% marginal tax bracket. So I think that's pretty favorable as it is.
Right.
But it certainly shows you that you can't always count on what the rules are going to be. And I think that's probably the biggest negative of this change is, oops, once again, they're changing a big rule that people have spent a lifetime creating plans around, and now they've pulled the big switcheroo. It has to make any reasonable person wonder how far down the road Roth accounts will be means tested. In other words, you don't have to take money out of them and it wouldn't be taxable. But that they might even change the taxation on it, I doubt it, but certainly they could make people take money out of it. They could do all kinds of things to the Roth provisions. And it certainly makes that more suspect in my mind, that it's not a given that a Roth account is forever tax-free if you follow the rules.
I do know, the kind of counterpoint to that I've heard is, look, if they start doing too much shenanigans with taxing Roth growth or things like that, people just won't contribute to Roth IRAs anymore or Roth accounts anymore, and then they'll lose a ton of current tax revenue. It's like with Roths, the good thing from the government standpoint, when people contribute to a Roth IRA versus a traditional IRA, is they get their tax revenue now because you're being taxed on the money and then putting it in your Roth IRA. Versus like a traditional, you're getting a tax deduction now, and then the government's getting their tax revenue way down the road.
Yep.
So I know from like a short-term standpoint, if they do stuff like that, and then a whole bunch of people stop contributing to Roths for that reason, then they lose a whole bunch of short-term tax revenue. But I agree with you.
I'm cynical.
It just goes to show they can just change things. So
yeah, and they've been threatening to do so.
It's just one more layer of certainty in any sort of financial plan, and there's a lot of other things that we don't know. So that's why I always remind people, look, you just have to make the best decisions you can today with the information that's available, and then you adjust when new information comes out.
A lot easier to make those adjustments when you have a competent, trusted advisor, though. I talk to prospective clients all the time. I said, one of the benefits of having a financial advisor that's competent is they will know what to do when life curveballs show up. This is a big curveball to a lot of families. And I doubt if the average person is set up to really come to the right conclusions, whether to do what the impact might be. It's not because they're not bright. It's just not what they're trained to do. Always felt one of the greatest benefits of hiring. Some people would hide their financial advisor, depending on when it is the advantage of hiring a financial advisor ahead of time is these things are going to happen. And a good financial advisor knows ahead of time. For instance, with our clients that are retired, we know ahead of time what market conditions would have to take place for them to slightly decrease their spending or maybe significantly increase their spending, depending how bad it gets. What conditions would ahead of time need to take place where we would say, look, your plan overfunded, you could spend more money, and this is how much more you can spend. Or knowing ahead of time, if a plan is overfunded, how much you'll reduce their stock market exposure and vice versa. But these other curveballs are going to come up too. And it's not just the ones the government, thrusts upon us. It's my daughter just lost her job, or my son or daughter are getting divorced and they're going to need help. How do we solve this? Just one more curveball. This one was thrust upon us from a government whim, I think.
And I think whether it be the government or it be just life's curveballs, these are these can be very emotional decisions. And a lot of times when the decisions are emotional based, as so many often are, your mind gets clouded and you can't make clear judgments or make good financial decisions during those times. So it's important to have somebody who can kind of steer you through the fog and see things from a different perspective than maybe someone who's going through one of these issues. And that's, again, like we've probably said 100 times, it's the value of an advisor, the different perspective and seeing things on a daily basis that maybe a client sees once in their life.
How many hours have you guys already spent on this Secure Act change and contemplating what it might mean for our clients?
Yeah, I mean, I've probably read a few hours worth of stuff, and then I'm going to be watching like a really in-depth webinar coming up this week. But I still have more to learn. I know one other thing that I had read, and I still just at this point I'm not an expert in it, but for people who have made trusts the beneficiary of IRA accounts, it can have a material impact. And rather than try to pretend I'm the expert in this, I would just say, if you have a trust listed as your IRA beneficiary, you should probably talk to your estate planning attorney about that and get his thoughts on whether or not an adjustment's needed.
Would you say they should probably, or they should?
They should talk to their estate planning attorney.
Right. I don't mean to pick. I'm not being picky and trying to be cute. I'm just saying, I think that's one that is so strong that perhaps a better phrase would be they need to go do that.
Well, because maybe he'll say, no, everything's still fine. And then at least you have the peace of mind knowing, okay, everything's still fine.
Go ahead, Fred.
Yeah, an adjunct to that is that young people who are dependents no longer get the advantage. Lower tax rates are actually taxed at the trust rate, which is really high. So leaving it to a really young child is probably not a good idea, while it was a great idea.
Yeah, because you don't get that. You don't get the offset of all that time over a lifetime. It might be,
But you also, they're not taxed at ordinary rates; they're taxed at trust rates, which are really high.
Right, and they get really high really fast.
Yeah.
So I'm going to shift a little bit to 10 events. Freddie, you all right there? It sounds like somebody behind you got murdered.
No, I don't think so. I'm all right. Anyway.
You are in Chicago, Fred. I'm a little bit worried about you.
Right.
I want to make sure you're in a secure building, preferably a police station. Sorry. So the 10. I think I can say this. I'm helping write some commentary and some information for a section that's going to be in the News Gazette. They don't have to use it, but this is some of the things I suggested. But part of it was 10 events that investors used as reasons to sell stocks over the last decade. The first one I list was the flash crash of 2010. People soon forget this, but in about 30 minutes, the Dow Jones Industrial Average fell 10%, and it was 1,000 points. If people want to get picky, it was like 996 points. I'm rounding. And certainly there were a lot of articles written about, the game has changed. These high frequency traders have ruined the markets. We just can't play anymore. In fact, there were some articles, one written in the Wall Street Journal about a family that they rode all the way through the 2008, 2009 financial crisis. But then just when the flash crash, I think their name was the Pultykes or something like that. And I just remember that article. I was fascinated. But then the flash crash happened. They said, that's it. We can't take anymore. It makes me wonder how many other people use that as a reason to just be human and say, I give up.
Don't you think some people just feel like, oh, this is just evidence that the game's kind of rigged against me? There's these professionals out there that make it difficult for the normal person to succeed, which is not the case at all, especially if you follow our investment advice and just use index funds, then you don't have to worry about it. But I think that's the response that some people had, was just, I'm just so sick of Wall Street. Game's rigged. I'm just not going to play it.
Yeah. Basically. So there's that emotional part. There's the frustration and anger. the game's rigged, I'm out. And then the left side of the brain takes over and backfills with logic. Well, these high frequency traders now have stacked the deck in a way I can't make money, whatever that might be.
And that's what's always so funny about looking at or these drops or whatever you want to call them is, and instantly somebody writes a story that says this happened because of this. Causation is instantly inserted. There's not very good due diligence to say that, well, these certain events happen, but there's no correlation, or maybe there's low correlation that this has an impact on the market conditions we're seeing now. But it strikes fear into so many people, and in that family that you're talking about here, Paul. It's the straw that broke the camel's back for them. I mean,
and it can be. We witnessed that at the end of last year. One client called and said, "I've had enough." We talked him out of it. Fortunately, we're not talking out of school. It's probably felt like a lot of people felt at that time. I'm going to kind of go through these somewhat quickly, if you can believe it. 2011. So if 2010 flash crash didn't do it to you, certainly it would have. You're welcome to the human race if you sold out in 2011 when the credit rating agencies downgraded the U.S. debt from AAA to AA+. So that was boy, was that a big groundswell of doom and gloom, and the world is over. Doom happens, gloom is a choice, probably. 2013, then just to show more chaos, 2 bombs explode in a terrorist attack. That was one in the Boston Marathon. So now we get another terrorist attack. By 2014, oil prices collapsed, and a lot of people were writing articles about, that means the economy is going to go into a severe recession. 2015, we had a stock market crash in China. 2016 was the year of Brexit, and it was a year of something. And of course, Brexit was, the game's over. The European Union is going to come apart, et cetera, et cetera. And then also in 2016, billionaire Donald Trump was elected president. And I can tell you, people called me the day after saying, what are we going to do about this? Basically intimating that we're going to sell, aren't we? 2017, we had Charlottesville riots that set off a lot of divisiveness. 2018, the Dow has its largest point decline in one day, and the stock market enters bear market territory. That was pretty brutal. And then 2019, of course, had its share of trade war and inverted yield curve threats. All through the decade, every one of those would be a logical reason, both an emotional reason to sell, and there was plenty of logic where you could backfill your decision with logic. And over that decade, just as an aside, $1 invested, and this is going to be part of that article, $1 invested in the Standard & Poor's 500 index, this is with dividends reinvested, of course, on January 2010 would have been worth $3.57 on December 31st of 2009. So your money more than tripled over this decade. Had plenty of excuses. So you could not at least now see the cost. Now you have to remember, you can't invest directly in an index. I want to say that from a disclosure standpoint, but you can buy an index fund that's almost free that come with very close results. The point is not everybody should invest their money in the Standard & Poor's 500 index. It's just saying, look, the broad U.S. market was a pretty special 10 years for that. The 10 years before was horrible, of course, but we had lots of reasons to sell, and none of them really were valid, or at least the payoff wasn't there.
Well, and that's my takeaway anytime you look at stuff like this is there is always a reason to get out of the market if you are invested, or stay on the sidelines if you're not invested. And it just goes to show, if you actually, follow through on your kind of emotions and feelings and do get out of the market or stay on the sidelines, how much you can end up costing yourself.
I think that's where do-it-yourself investors really have a hard time. I mean, how many times have we heard, well, I think I can do it myself. I'm going to follow the 4% rule. And then when you ask them, well, have you read the 4% rule? Well, no. Do you know how it works? Well, not really. But that's how you're going to run the next 3 decades of your life with basically, you don't even know the rules. And then, by the way, the rules are, I'm never going to look out the window on this long journey in my car. So I don't need mirrors and I don't need brakes because I'm never going to stop. I mean, how many times do we hear a do-it-yourself or tell us what they're going to do? And the strategy is pretty close to, here, hold my beer, watch this. I'm not saying it's stupid to try to do it yourself. Obviously, we're biased. My point is, it always circles back to everybody's got a plan until they get hit in the face, as Mike Tyson said. And I think that's the biggest challenge for the do-it-yourself investor is there are all these pivotal emotional moments available at any given time that seems very rational to exit your lifetime holdings of the greatest companies of America and the world.
Well, and I think each one of these in real time, people felt like, oh, well, this time's different. Like you always say, that's kind of like the 4 death words is this time,
Right.
time is different. I do think, because now looking forward, people are, for one reason or another, they're worried that, Donald Trump's going to get reelected, or maybe worried that Elizabeth Warren gets elected.
Right.
I've heard both.
Yeah.
I've heard both concerns.
Right.
And I think, especially with someone like Elizabeth Warren, the people I hear is like, oh, well, there's never really been a president quite like what she would be like. And every one of these, when you look at it in real time, it does feel like, oh, it's this new unprecedented thing, and it's a totally logical reason to get out. And then when you look back at all these things that were, unique and different in the past, and the market still goes up despite them. So for the people who are looking at things now and looking at reasons to not be invested, just remember that there were a lot of people doing the same thing, 5
Right.
years ago, and then they miss out on this huge bull market.
And to go along with just what $1 invested in the S&P 500, the Standard & Poor's 500 index, which represents the 500 largest companies in America, the dividend income stream over the last 10 years, the last decade, if an investor invested $100,000 in the Standard & Poor's 500 index, they would have seen their dividend income more than double net of inflation. Can you believe that? In 10 years, the dividend income more than doubled, even net of inflation. I mean, that's pretty incredible. When you think about going into a 30-year retirement period where your cost of living, if history is any guide, is going to triple throughout retirement, how important a rising income stream is. And I think that's the one thing that very few investors or even advisors talk about is the power historically of a rising dividend income of the great companies of America and the world. More than doubled. I thought that was pretty impressive. Fred, household net worth over the last decade, pretty close to doubled to all-time highs.
Right.
I think that's pretty impressive.
Financial assets. Yeah, and I guess for the listeners, it's probably good that a lot of the doubling came from financial assets, not from housing values. For people that had only their house, it's obviously not as good news. But again, we're kind of getting away from the idea that the house is your best investment.
But housing prices, I was looking at from the data from the Federal Reserve Bank of St. Louis, the house price index rose to an all-time new high. It started the decade in around 325 and it ended a little bit north of 450. So people saw their home prices in the aggregate go to all-time highs, bottomed in about 2012, as it turns out. Homeowners' equity also bottomed in 2012 and is at an all-time, and it bottomed at about $7,000 or $8,000, and now it's close to 17 or 18,000. I think that's pretty impressive. Maybe I'm reading too much into it, but I think sometimes people are surprised. The one thing, Fred, that I got from these series of charts that I'm going to include, or I intend to include in the article, is this household debt service. The household debt service as a percentage of disposable personal income fell to the lowest amount for over 4 decades, and maybe even 5. It's dropped to levels. In other words, people's debt burden compared to their discretionary income has fallen to levels that virtually unseen. Do we make anything of that?
Future. Well, I think the explanation obviously is the super low interest rates we had during this recovery period. So if they ever go back up again, there'll be a little bit heavier burden. But some people now are thinking about a new world where we bounce along at basically zero inflation for a long time, and that would mean interest rates stay very low.
And it looks
again,
like,
I think the same issue is true with the federal government. The federal government now is able to manage its debt very easily because of the super low interest rates. But again, if we go back to a world of 6% inflation, it's a different game. I don't think we're going to do that, but that certainly would be a big change.
I agree. And however, it's pretty clear to me when I look at the data, I think what I take away is corporate balance sheets have certainly improved and deleveraged, and the household in the aggregate has really delevered and really reduced their debt. We do have a call, though I can't see who it is, so I'm just going to go blind. And welcome the caller on line 2. Welcome to Paul Rudy's On the Money. What can we do for you? Hello? I can't see the name. Caller, are you there on line 2? All right, we're going to go ahead and drop that one then, just in case. I can't see on my screen. I'm sorry, Austin. It doesn't show. So I looked at that as a positive. So we have increasing household net worths, increasing house prices. Obviously, Fred just highlighted it. The 10-year Treasury started the decade at the 10-year Treasury started at 3.73 and ended the decade at 1.68%. So obviously, interest rates, household debt service improved because of interest rates for sure. Unemployment rate at a 50-year low. This is interesting. Gold was up 40% over the last decade, but then again, the stock market was up 207%. So as impressive as some people might be about gold, really not all that impressive when you could just buy the 500 largest companies in the U.S. and had pretty impressive gains. Unusually strong gains, though, as I said at the beginning of the show, for the Standard & Poor's 500 index. One of the things, Dave, just thought of, a few months ago, I think I wrote a blog, at least I told you guys about it. I had researched every 20-year period in anticipation that by the end of 2019, that the 20-year period starting in 2000, those 2 decades, would be one of the lowest compounded annual returns for the Standard & Poor's 500 index in history. It's not the lowest, in the lowest 5%. And how unusual that is. And then you try to wonder, does that even mean anything? We're quick to say what happens today doesn't have any impact on tomorrow's stock prices or this year's, next year's. But when I look at every 10-year period after such a low 20-year stock return for the broad U.S. stock market, I mean, if the stock market were to double over the next 10 years, that would be an amazingly low estimate of what it has done compared to what it's done historically. I don't know if it means anything, but it typically would go up 4 to 5 times, if you can imagine it, in the next 10 years, if history is any guide, and it's not predictive whatsoever. But you start thinking, a lot of people are talking about returns are going to be terrible over the next 10 years. I don't even know what to make of it. I was just pleased that I beat a really good writer to the punch on that story.
Yeah, the biggest thing I took away from the article that you're talking about was he looked at, okay, let's look at 10.
And this was Nick Majuli from on Dollars of Data blog. He's part of the Ritholtz group, who we know those people pretty well.
But he looked at, okay, what were returns over the prior 10 years? And then what are the returns following the next 10 years? And then what's the correlation? So in other words, does the fact that the last 10 years, just using the recent, decade as an example, does the fact that the market decreased so much over that decade mean that it's more likely to have poor returns over the following decade? And what he showed was that there was a very, very, very weak correlation. It was like negative 0.19. And so the takeaway is, just because market returns were good over the past decade absolutely does not mean that we're due for poor returns over the following decade. You really can't draw that conclusion if you just look at the historical data. And I think that's really important, because I am hearing this more and more often these days, is we're due for a correction. We're due for a market decline. We're due for a bear market. I'm hearing it more and more frequently because the market's gone up substantially, especially 2019, obviously being a huge year. And if you just look at the data, that's just not the case. So it is intuitive, but I really liked the example he used. It's kind of like when you go to a casino, if you've ever been in a casino and you have the roulette table, they'll always show like the last several rolls, because people start to draw conclusions from that. So if it landed on black 5 times in a row, that doesn't mean it's any more likely to land on red the next turn, but people still feel like it does. And that's just human nature. You see patterns and you expect reversals and things. It's similar with the stock market, where, look, just because it's gone up a lot over the last, X years does not mean it's more likely to go down over the next, X years.
It can drift far away from what you're thinking is going to happen. It's actually called random drift. You could take something as simple as a coin flip game 10,000 times, and you can have some results that are really far away from, you expect a 0 return, and it can be really far away. So you're right about that.
And the other thing that I always remind people is, let's just say you're right and we are, quote, due for a bear market. Well, we don't know when that's going to be. That could be 3 years from now.
Well,
you could miss out on 3 of great returns, even if you're, technically right.
Right.
You were right way too early, and then maybe you go back down to where we are,
and it's irrelevant.
Or even if you get it right and it does fall, you're not going to know when it bottoms out and when to get back in. So there's a good chance you miss the recovery. So that's the thing that's really tough about market timing in general, is you have to be right twice, and then you have to do it consistently over the rest of your life.
Yeah, good luck.
Yeah.
What I think everybody continues to miss, and I'm going to say it, I'm coming out of my foxhole with my gun up in the air saying, look, it's not necessarily overdue for a bear. I don't know what's going to happen. We could start
Exactly.
today.
It could
That's not
happen.
my point. My point is what I think everybody has missed through the last 10 years are, we had a bear market in 2011. We had one in 2016, and we had one in 2018. Okay, we've had 3 of them in the secular bull market. People are going to call me, and probably Stan, and say, we did not have those 3 bear markets. Okay, 2 of them were off by a fraction of a percent. The one in 2016 was down. The broad U.S. market might have been down 15%, but you looked at small caps and emerging markets and global stocks and just about every other area, they were down somewhere around a quarter to a third in value. I count all 3 of those as bear markets, and considering you get one on average throughout your lifetime about every 5 years or so, I think it's a bogus argument anyway, and it's an irrelevant argument. I mean, I think that was your whole point. It's unknowable. We're not due for one. They don't come because we're due for one. They will come because typically of a recession is the most often reason that we get them. And recessions are unpredictable, at least consistently so, except for Fred. Fred can do it.
Yeah. Well, so look at last year, though. There was some kind of year-end accounting of people's prediction, and no one even came close to estimating what the market would do last year. They were within. Experts don't really know what's going to happen. They may have some idea, but it's very, very unlikely they're going to hit it on the nail on the head.
Well, experts will fill your ears, but they won't fill your wallet. That's for sure. Fred, the federal.
No, I don't think you heard it anyway. No one was predicting a 30% increase in into 2018.
No, I think you're right. Nobody that I could find.
I agree with that Peter Lynch quote where he says people lose more money trying to avoid declines than in the declines themselves.
Right.
That's not word for word exactly what it is, but that's the gist of what he said. And I think there's a lot of truth to that, because people they worry so much about experiencing a decline that they end up costing themselves even more money just in missed upside.
Well, in the middle part of the decade, Fred, we started making progress on deficits. They were only $500 or $600 million or $1 billion. Now suddenly we're looking at $1 trillion deficits again. What are we to make of that?
Well, I guess there's a little bit of uncertainty now. I think nothing bad in the short run. The long run, obviously, is sometimes someplace we're going to have to deal with this. But again, it's always a few years in the future. The other problem, which again, if we move into a recession, we're basically out of ammunition before we start. The interest rates are so low that it's hard to get much of a bang out of lowering interest rates by monetary policy, and we're already running a $1 trillion deficit during the lowest unemployment in the last 50 years. So it makes it a little bit more tenuous if we move into a downturn about what the government can do. But aside from that, I don't think there's any short-term issue. Again, at some point, obviously, the debt can become overwhelming, but I don't think we're close to that limit right now.
Yeah, it's just amazing. That really just almost makes me sick. And it's both sides of the aisle are just spending like they're irresponsibly spending, and it's just bizarre. But it doesn't make me a pessimist or a cynic about the future. It just disgusts me to watch what politicians will do with other people's money.
That's the only thing that Trump and the Congress can agree on is spending more money. That's the only thing they've ever come into harmony together.
Quick question. It's from a text. It says, does the Secure Act include stretch IRAs? And I think, if I'm understanding the question right, yes. Mm-hmm. You're not able to. Now, you still, if it goes to your spouse, and there's a number of exceptions. Dependent children, disabled. There are some exceptions, but in the aggregate, I think it's fair to say the rule that used to allow you to inherit an IRA from somebody and then take required minimum distributions over your life timetable is out the door for practical purposes. Well, Fred, we appreciate you being on the show today. You travel safely. You'll be back.
I'll see you next.
Oh, we don't have, there's a side, I'll announce it here. We're not going to have a show next 2 weeks from now. We're just not going to have one that day. A lot of us, our schedules aren't going to allow it. So that one's off, Fred, unless you want to come and do it by yourself. But otherwise, Fred, say hi to Donna and safe travels.
Okay, thank you.
Thanks.
Bye-bye.